moment right now, this moment right here has been in the making for 13 years. Through trial and error is how I paved the way. It's not an overnight success like you see it today.
There's a lot of truth to that, and I wrote that song because it is a lot of trial and error that has got to me where we're at today, and the ability and the real life experience to explain money, to teach you about money. I would like for you to open your mind and open your heart as you listen to this, however you stumbled across this, whether if it was sent to you, if you were following our journey on the Rule of 35, however it is, this moment, give me your attention for 10, 15, 20 minutes, however this audio lesson is, because open your mind to really wanting and having a desire, not only how to manage your money, how to make sure money is coming, not only in, but we're utilizing it in the right way to set you up for success, but then also how to create it, how to make money, how to make more money. That's what we're talking about today. I'm going to show you an example on the Rule of 35 to where the same income, but one is self-employed, the other is W-2. I'm going to show you the importance of self-employed 1099 income and what that does to your after tax, after debt income. Before we get started, let me play a little bit more of the song. So it's not an overnight success, your journey to understand not only how to manage your money better, but how to make more money. A lot of times we get in a hurry. We want to do things fast. We see where somebody else is. We compare ourselves to them, but we don't realize that they've been doing that for 6 years. They've been doing that for 10 years. You're just starting out, whatever that may be. And that's important to have a great perspective. But stay on the leadership channel. This audio lesson, you could follow along as you're, listening on your podcast or listening in the car or driving. But if you want to follow along the screen as I, explain this, I'm going to share my screen and it will be on our YouTube so you could see not only the audio, but the screen as we talk about it. But in the interim, continue to study the content, audios, videos that were given to you on the Rule of 35. Stay on the leadership channel to go through our leadership course. There is a total of 14 lessons ending with money management. When you listen to those lessons by Virgil and you get to identify the problem in self-image and chapter 6 or lesson 6 on appreciation and opportunities or resentment and criticism, man, that's a great one. Listen to them in the order that they are listed and then start reading the books below. That has been a course that has been taught by my grandfather since 1980s, changed the lives of countless people in a wide variety, the richest in town or the people that are just broken and destroyed and, wanting to get better, wanting to repair their marriage. Virgil will teach you through stories and lessons, so I challenge you to listen to that. Let's dive into the lesson, though. I want to explain one time on the Rule of 35. You can learn more on the weekly video that we put up on the leadership channel. Every week we're going to be giving you at least one new audio lesson to study, a video lesson, an online course. So it's not just audio. I want you to visualize this. So many people know how much money they make. We're going to use the example of $100,000. And then we are going to solve first for what is your debt to income ratio. Your debt to income. What is debt? Debt is any loan, a mortgage loan, an auto loan, a student loan, a boat loan, a personal loan, and any credit card. What is your monthly debt payments? And let's say we calculate that. It's going to give you your DTI. In this scenario, let's say this person's DTI was 27. The Rule of 35 is we apply in two areas. A, we want your debts to be 35% or less than your gross income. Okay. And we calculate this for you. This is a code that we are building out. Soon you'll be able to do all of this yourself. You can see it gets orange and kind of a caution if you get into the 40s and the high 30s. But if you're above 50, like a lot of Americans are, because we don't make enough income, we haven't been taught not only how to manage it, but how to make it. It's very hard. It's impossible to run this formula at a $56,000 a year salary. Why is that? Because there's no money left over, even if your DTI was 35. Okay, at 35, you don't have enough living expenses to pay all your bills, to pay your car insurance to pay your internet, your phone, your food, your gas. Okay. So that's the average salary. I think in America is around, in the 40s, low $50,000. But in this example, we're going to use $100,000, and we're going to say this gentleman's debt to income is 27%. So now that we know what his ratios are of debt towards gross income, that's what we use. When you go get a mortgage loan, when you go get a loan, they figure out what is your qualifying income and what is your debt to gross income ratio. Now we have taxes. We have built this algorithm so it takes into consideration of how to calculate your taxes. And if you make more money, that formula would calculate it. So $100,000, you're paying about $1,500 a month in taxes. So the after debt, after tax income is about $4,500 in this scenario. That's after your all debt is paid. Loans, credit cards, mortgage, car. After your taxes are paid, it leaves $4,576 left over. And if you follow the rule of 35, you're going to learn why you should be and how to be investing 35% of your after debt, after tax income. So this is somebody who's W-2, a W-2 employee at $100,000. Okay. When you are W-2, there's a lot of security. Okay. You are a great employee, not knocking that. You work for a great company, great benefits. There's no question about that. Matching 401ks. There's nothing wrong with that. But you're W-2, so you have limited available tax deductions when you are a W-2 employee. After looking at countless tax returns and financial statements over the years and really started looking at formulas and the importance of seeing how your income is coming in, where is it going, and how can you reduce your taxes and your debt to have more after tax, after debt income to invest. This is the stuff that you will not learn if this is your first audio lesson. Yeah, I probably lost you when I started calculating. If that is the case, go watch the screen share video and follow along, and you're going to continue to study this because it's a journey to learn this. We in America are way out of balance of where we should be financially because we haven't been taught how the little decisions we are making is affecting our life. So if we take taxes, W-2 employee, we're estimating, I'm not a tax accountant, but I'm a businessman. And when you start running your personal finances like a business, you will see dramatic change. The research shows as Americans, the mass majority of adults, working adults, are not saving. Our debts are too high and our living expenses are out of whack. So we have to continue to grind, continue to work, continue because we don't have any savings built up. And so when you get smart and you start to go deeper with the rule of 35, okay, I want to show you the importance of what if you had 100,000. This is six figures. A lot of people don't even make six figures. If you want to make six figures, we're going to show you how to do it on the side in three industries: mortgage, real estate, insurance. Which one are you interested the most? But first, you have to be willing to learn the rule of 35. Then you're able to get compensated teaching the rule of 35 and helping people lower their DTI, with structuring a mortgage loan. Let's say we can use a mortgage loan for this customer and bring their DTI down to 19%. Okay. And everybody should be looking at borrowing money right now under 3% on these terms on a 30-year AM. You can't go to a bank and borrow that money right now, but you can by using a mortgage. But when you look at it the right way, now we used a mortgage. They learned the rule of 35. We just gave them extra investable income and livable income. So this same 100,000, if you are 1099 means you're an independent contractor. I was talking to somebody today and he made a reference of what if I bought an investment property? And is that self-employed income? That is Schedule C or E income. That is on Schedule E. Yes, you get deductions from that income associated with that property. But if you also have a business like real estate, mortgage, or insurance, and you are able to get paid 1099, you have a lot more deductions. I was talking to a lady today who is a great a highly paid employee. She drives 40 hours or 40 miles each way to work, 80 miles a day. And that's a lot of miles a week, a lot of miles a month, a lot of miles a year. She's W-2, so she cannot deduct car expenses, mileage, right? That's an extra 10,000. You cannot, most of the time, you cannot deduct meals, entertainment, business travel, if you travel associated with business. So there's so much more that you can deduct that you're already spending. That's the difference. You can argue, well, I don't want to go spend advertising or marketing. Okay, well, you don't have to spend advertising and marketing. But if you just continue to spend the same amount of money you're spending down here, okay, a lot of these are tax deductible. So if we were able, don't pay attention to the DTI, they're building a formula to calculate the tax strategy for self-employed income down here. But let's say it's about 32,000 in deductions, okay? So if we were to pull her this taxable income to 68,000, so it takes it down to 895. Okay, I'm going to put it back because it messed up my other ratios. So what that means is instead of paying $1,500 on average a month in taxes, we lowered it to $895. That would save or add an additional $611 a month in investable income or after debt, after tax income. Let me show you the importance of that. If you look at the little decisions you're making, this client, guys, look, same debt payments, same income. This one's W-2. This one is 1099 if we had a side-by-side comparison. And the difference is literally, what is that? About $7,000 a year that you saved right there, that it becomes investable income. So if you take that 611 and 611 more here, the rule of 35 is you should be investing 35% of your after debt, after tax income. So 35% of $611 would be an extra $213 to put away inside of investment. There's a lot of opportunity to invest money. I'll talk to you guys briefly about that. So let's calculate that. So by having a ability to save that much in taxes, if you invested $213 a year over 30-year period, average to assume rate of 6.5, some years are more, some years are less. That's a fair average. If you look at what the S&P or the Dow Jones has done over the last 30 years, that's an extra $228,000 of retirement income. So times are changing and we're seeing that shift. More people want freedom. More people want the ability to, not have to worry about losing their job during a pandemic. A lot of people are trying to figure out how to make more money. How do you do that? Is you go watch this video and follow along how I explained that, how we broke that down, how we just saved $7,000 a year by being smart of making sure we have some self-employed income coming in. Continue to study the leadership channel. These courses, as I put content on the rule of 35, as we build this where you can figure this out yourself, we can help show you how to not only where you're at in the rule of 35 if you call us. Somewhere's on my phone, our phone number, or book a call. We'll show you not only where you're at with the rule of 35, where is your DTI today? What if you're at a 45, 47? It's dire. This is not sustainable over a long period of time, even at $100,000 a year income. Let us teach you how to use mortgages to drive this down, how to really look at your debt, where your money is going in debt, how much are you paying in extra debt that you shouldn't. Let us show you how to drive some self-employed income to drive your tax liability down, okay? And so instead of being in the tax bracket that jumps up at 100,000, we stay in this tax bracket. It saves a lot of money in taxes. And then we can show you how to invest and save and how to use this money to save money, like when you're investing in real estate, how to invest in real estate the right way. Even if you can save $2,000 in this bucket as it continues to grow, then that's an extra $2,000 that's earning a rate of return. Even at this, if you're putting $1,000 a month, $1,000 a month when your formula is in line, look, that grows to $1 million. So over time, this investment account is going to continue to grow when you follow the rule of 35 and you get your numbers in line and you figure out how to get your income from 100,000 to what is that? 100 and say 175,000. So you figure out over the next 5 years how to be saving or making an extra 75,000. And look, if you do not pay or figure out how to drive self-employed income, look at your tax liability. Look at your tax liability. Now that we have more income, I know we have more expenses, so our tax liability can go way down because we have a lot of more deductions that we would qualify for. Look what happens if you make 250,000 W-2. It looks good on paper, and it is good. If you have a $250,000 a year salary W-2, there's absolutely nothing wrong with that. So you know, in your mind, you're $250,000. It's a lot of salary. But if you look at making a $250,000 W-2, you're paying about, say, $50,000 in taxes a year versus 250. Yes, we're going to still pay a bunch of taxes, but maybe we only pay taxes on 100,000 because 150 of it was tax deductible. We just saved about 40,000, maybe closer to 30,000 on our taxes. So that's what we want to teach you. The importance of really understanding how much money you're making, where's the money coming from, how much of the debt, what is the percentage of your gross income to the debts that you have, how much is your tax liability, how to drive your debts down, how to drive your taxes down, because this is the number we want to increase for you. We want to increase your after debt, after tax income. We want to show you how to apply the rule of 35 and invest 35 here, 65 here to live on. And we want to help you really get your numbers in line. Whizango is a company that has been built and designed through the experiences that I've had in my life and really seeing the failures, the good, the bad, and really looking at how can we educate you on how to be successful. Design your life with us for 5 years. Learn and follow this formula for 5 years. If I showed you the math that you're going to learn, if you'll stay on that leadership channel, keep listening to these audios, as repetitious as it sounds, the benefit that you're going to get if you made it all the way to here and learning this formula, it's going to come more and more inside of you. And it's going to be your guide. When should you buy a boat? When should you go do a big investment? Well, how much do we have here? Can we do that and it doesn't go above 35%? Can we be smarter to drive the tax liability further down to offset some money? Every little bit makes a difference. Little decisions compounded over a long period of time are powerful. That is the power of compound interest. I was showing a guy today how to free up enough cash flow, how to restructure debt, how to look at what kind of money he has coming in. And he would be able to invest about $5,000 a month. Look at the importance of that. Look at how much that grows to. It grows to over $5 million over 30 years. And you're able to, you put in 1.8 and it's grown by 3.5 to equal 5.3 million. And you're able to utilize this as a banking system, as your nest egg, as your investing account. And we will show you how to do that. It's not a one size fits all when it comes to investing this money. We want to show you a lot of potential, what you can do here. But more importantly, it doesn't matter what you invest in if there's no money to invest. Learn the rule of 35 to get control of your money. The mass majority of Americans are struggling to understand this because we just haven't been taught how this works, how our debt works, how's credit work, how to have good credit, how to manage that debt, how to not get overextended. Because it doesn't matter how much money you make. If you're overextended, you cannot make enough to live on. This is where the formula begins. What is your debt to gross income ratio? That's what when you come to get a mortgage, that's what we qualify you on. And I want to show you something. Everybody should be looking at borrowing money at these interest rates. If you have a house that's paid off, where you can take $400,000 or $200,000 or $100,000 at an interest rate of 2.7, 2.6 on a cash out on a 30-year note, and you restructure your debt, it makes an unbelievable difference. And even on a 15-year, you're talking being able to pull cash out at a 15-year note at say 2.122. Now, this video is for educational purposes, and those are the rates that are in the market. And we can show you how to get the right rate, how to save on the mortgage, how to get the save on fees, how to really be smart about how you go get a loan. We have contracts with some of the biggest and best companies in the country. We don't have to ding your credit multiple times. We really look at advising you. We could take you through the whole rule of 5 strategy without ever dinging your credit once. So, never again are you going to be able to borrow at these rates, though. And when you can see you can borrow at a long-term note at 2.7, 30-year fixed, you can't go to a bank and get those terms if you wanted to start a business, if you wanted to do something in the future. Now is your time. Those terms, being in banking as long as I have, those terms, when you look at the power of numbers, this is one of the best opportunities in history for us to restructure our debt, to restructure our cash flow, to use a mortgage loan to do that. See, a mortgage should be the last loan that you're paying off, getting out of debt. We can show you the math on that. It's better to wipe out credit card debt that's higher interest. It's better to wipe out car loans, even if they have 0 interest, because we are replacing a short-term loan with a bigger payment and a long-term loan. So we can maybe pay off $50,000 in car loans, save $1,200 in monthly loan payments, and it only increased our mortgage payment by, say, $140 at these interest rates. So it's a great time to be looking and learning this strategy. I hope you enjoyed this short little audio lesson. I'm going to really push you to stay listening to them. Shortly, you should be able to be back on our leadership channel and watch the screen share to learn and follow along as I went over these numbers. The more you listen, the more this will become second nature, and understand the terms of after tax, after debt income, and what is debt to income, and tax liabilities, and investing 35%, and knowing where your money is going. We're just getting started with what we are about to build off of this. I want you to know that Whizango has your back. We're here for you. So call us if you need us, send us a message, reach out to us, however you do it. Just know we got you.